Welcome to Executive Conversations by the Paypers. I'm Dwayne Gefferie. In this episode, I'm joined by Cactus Raazi, CEO Americas at B2C2. We're discussing how B2C2 is building liquidity infrastructure for digital assets and what that means for the future of institutional crypto trading. I don't want to jump straight right into it, right? Most people in payments will not have come across B2C2, even though you move billions of dollars a day. So maybe give us a little bit of an introduction about what is it that the company actually do and who is it for?
B2C2 was founded over a decade ago as a crypto market maker, liquidity provider. Our primary activity is to serve exchanges and our institutional clients and providing liquidity to them when they want to buy or sell digital assets. And more recently, we've made a lot of investments in the stablecoin space, and our client base has grown to include payments companies, and more recently even credit card firms and a wide variety of other firms in consumer financial services that are adopting some portion of blockchain technology for applications that are outside of core crypto.
Fantastic. So maybe let's walk through that, right? Let's say somebody wants to buy some Bitcoin. They open up the app, they have a couple of dollars in there, maybe in a stable coin. What is it that your firm does behind the scene that makes that happen?
Yeah. So we provide prices not only to exchanges, you could Coinbase or Kraken or Binance or over 40 exchanges globally. So part of what we do is we act as either a liquidity maker, that is to say, providing prices to allow transactional activity to happen, or sometimes we're also taker. So we'll trade on those exchanges to hedge ourselves, for example. And then there's retail platforms. And in the crypto world, there's blurring of the lines between the two. But a strict retail platform you can think of would be something like Robinhood or these types of platforms that have a large user base. And there's many of them globally. And we serve them by, again, providing prices so that their users can buy or sell a bunch of different crypto and digital assets. And more recently, with the rise of prediction markets, Polymarket is crypto native, so there's that. And then there's other prediction markets globally, both in the United States and elsewhere, that again are starting to adopt portions of blockchain technology. So that's a natural growth area for us. Not so much in the sports or in the celebrity bets, but in macroeconomics and in bets around core crypto. For example, they have one of the most popular contracts out there is whether Bitcoin will go up or down in a reasonably short time interval. So these types of things.
Yeah. So it's not actually betting on not buying the asset as in to see if it goes up or down, but actually placing a bet just on what happens with the underlying asset. Oh,
Right,
that's fascinating.
Mm-hmm.
Yeah. So you said it's already been 10 years. You're moving massive numbers of volumes already. But most of the companies that you're working with, the banks, the payment companies, they are your clients. So is it actually beneficial for you to be invisible or sort of like behind them? Or is it something else that you're working on?
No, I think you're right. We're a B2B company. We're strictly institutional. We don't have a user base of individuals, and we have no plans to do so. It's not in our business model. And so we support our front partners, whether they have their own retail platforms. Some of them are institutional lending platforms, for example, and other institutional businesses. An example would be custodians. We have a really robust franchise working with custodians who then provide liquidity to their customers. Again, all institutional, but we're essentially one of the liquidity back end to custodians' execution desk.
Absolutely. So really just behind the scenes, but making sure that those who are providing the retail users and businesses with the solutions, you're the one sitting behind that.
That's right.
Fantastic. So, but especially now, right? We see stable coins, of course, being everywhere, right? Like at different conferences, people are talking about it. It started out as a trading tool. Stablecoin started out as a trading tool, and then it made its way in and out of crypto, of course, making sure that it was pegged against, or at least helping with trading the other crypto assets within that. Why is that something that banks and payments companies are all of a sudden looking into and can't ignore anymore?
Really, more than anything else, it's it's a similar reasoning as to why there has been just general technology development in fintech over the past 20 years, which is generally it's either faster, cheaper, or preferably both. When you look at stablecoins, moving value from point A to point B is generally faster than doing so through the existing frameworks. That's particularly true internationally. And that is also true domestically in countries that don't have instant payment networks. So, for example, in Brazil, you have Pix, and you can move money very quickly, very cheaply in Brazil. But getting, let's say, a payment to a company in Singapore from Brazil is a multi-day process. And that's where stablecoins help. So I think, well, I don't think there was necessarily a lot of enthusiasm for blockchain technology within the payment space, but quite the other way around, that this is a new technology that is faster and cheaper than existing workflows. And so there, it naturally starts to be adopted.
Yeah. Oh, fantastic. So, especially if you look at the stablecoin market, right? You have USDC, you have USDT, and there's no one single dollar equivalent anymore. But you also have different currencies, you have different issuers, you have different networks all trying to get in there. You have companies like Stripe buying different companies and actually encouraging others to launch their own stable coins and their own platforms as well. Why does that fragmentation matter to anyone trying to move in and out of money?
Well, it's interesting. There's a couple things I'll say. The first is, why would you want to have your own stablecoin? Because that's what at the root of this concept of fragmentation is this idea that there will be many more stablecoins in the future. And we're seeing that, just a couple of days ago, MoneyGram announced its stablecoin. We're working with Western Union. They have announced the stablecoin, and we're very close to stablecoin orchestration firms. So there's a lot of things that I can't share publicly, but there are a lot more stablecoins coming. So why is that? I think that you want to think about issuing your own stablecoin if you have a network. And a network can be defined as a lot of different things, but you would certainly accept the case that Stripe has a network, hundreds of thousands of merchants. Shopify has a network. I don't have no knowledge about a Shopify stablecoin, but I'm using that as an example of a network where people won't necessarily think of it as that, but that's what it is. Telegram users are a network, and we can go on and on. Many, many networks out there. If you want to facilitate value transfer within your network, that's one if. But if you want to do that, you will likely want to own that technology because it allows you to then take advantage of that software in ways that are going to be potentially strategic in the future. So again, sticking to an example that that's all public and we know about, such as Stripe. Again, I have no specific information. I don't hang out with the Collison brothers, but I will say that if I were running the company, I would say to myself, I don't want a third-party dependency. I want to be able to develop software to run on top of my stablecoins for the benefit of my network. And I want to be able to control implementation. I want to be able to control timelines and costs.
Yeah.
Well, I think that's at the root of why Western Union wants to have its own stablecoin. They always had the option to use Circle, for example. Nothing against Circle, great company, great leadership. But it's, all of us who have built things in the past, as have you, we really don't like the idea of having third-party dependencies because you usually, when you call a partner up and say, hey, this is what I need, this is what I'm trying to get into production, they'll tell you it's going to be sometimes expensive, but even if it were to be cheap, it's going to be many more months than perhaps we had hoped. Right? They have their own development queue.
Yeah.
And so, therefore, you say to yourself, great, so network owners are likely to want their own stablecoin. And that results in fragmentation, but that is not the intent. I'd also point out that from a fragmentation perspective, there's a couple of different questions. There are solutions in the market to allow any institution to accept all relevant stablecoins, but to settle in their preferred Treasury asset. Yeah. We offer one at B2C2.
Okay.
And this is the ability to instantly and costlessly convert any one of currently about 18 stablecoins, and that number is growing, and convert them to your preferred Treasury asset. That includes non-dollar stablecoins as well. And so, we think we have the best solution in the market, but there will likely be others that will create such similar solutions. And that really obviates any concerns around fragmentation for the most part, because ultimately it allows you to settle and manage your preferred Treasury asset while still accepting a wide range of stablecoins. And this other thing I'd say is at the consumer level, it's unclear what the user experience will be. Certainly right now, if you open up your MetaMask wallet, and most people don't know what that is, but if you were to do that, you would see a bunch of different assets in there. But tomorrow there could easily be a fintech that abstracts away some of the many different assets you might end up holding. And then the last thing I'd probably point to is currently stablecoins can't pay interest, as we know, with the Genius Act, but it's really trivial to convert a stablecoin into a yield-bearing instrument. And so you would think of stablecoins as a superior product for the transfer of value.
Mhm.
And then you have other products that are likely better for store of value.
Yeah.
That could include deposit tokens in the future as well, and possibly many other developments that still lie ahead of us. And because the conversion is instant and effectively free, you as a user, you don't really care when you need to move things around. Quite likely behind the scenes, it'll be via stablecoin.
Yeah.
And meanwhile, when money is not moving, again, quite likely behind the scenes, it'll automatically be converted to a yield-bearing instrument.
Yeah.
So I think we have a bright future ahead. And I think some of these possibilities around programmability and convertibility, fungibility, I think some of these possibilities are why stablecoins remain such a hot topic, for example, here at Money 2020.
Absolutely. So, and I think especially on that point, like whenever I talk about stablecoins, doesn't matter with conference where we're at, there's always that point out by those who are in the trading part, probably which much more of what you're working on versus the ones who are working with, is stablecoin actually a store of value or something that we're using to actually buy goods and services with. And if you look at that, in the last year, I believe it was around $30 trillion that was actually being moved. And the majority of that, I think anywhere between 25 trillion or probably even more than that, was actually coming from going in and outside of those crypto assets, right? Probably a lot of the things that you're doing.
Yeah.
And then only a smaller part, only 5 trillion, was actually being used for other means, basically from merchant processing to settlement currencies, etc. What do you think the trend is going to be? Do you think that we'll continue to see a massive growth of going in and out of those cryptos, or trading that will continue to be, or even adopt more to going in and out of stable coins? Or do you think we'll see more on the other side, that growth actually accelerating on the acceptance of stable coins in retail environments, online, or maybe even agent to agent type of transactions?
It's unclear to me whether we're going to need to get to a place where stablecoins are explicitly accepted by point of sale. It could be abstracted in the background, depending on what's being developed by companies like, for example, Square or Clover, and then you have many, many other ones, all the acceptance companies, Adyen and Checkout.com. It goes on and on. It's a global phenomenon of point of sale. And it's unclear whether you're going to have to explicitly use a stablecoin or whether there's going to be sort of an implicit, elegant solution to being able to utilize them for spending at point of sale. I think at the same time, we're going to get I think it's very likely. I'm not really in the predictions business, to be clear. I think it's a terrible business to be in. But I will say it's very likely that corporate treasury moves to stablecoin native.
Okay.
And that to me is an interesting side point, because I think that, Citibank put out a piece of research several months ago saying, by 2030, the stablecoin market could be 4 trillion.
Okay. Yep.
And at the time, I think at the time it was probably closer to 220 billion or so, something along those lines. So the headline numbers looked really exciting.
So when you say 4 trillion, as in the money being
As in the
generated?
total, not the total amount of trading, but rather the total capital sort of being expressed in stable coins. Like
Okay.
right now, at the time, I think Circle was around 60 billion.
Yeah.
And the rest of it was Tether, obviously.
But it's the velocity that makes the bigger number, even though the actual value
No, it's just that
stablecoins is 4 trillion.
those commensurate numbers of, like, let's say 220 billion at the time was going to be 4 trillion by 2030. So
Yeah.
long, some years ahead. I think that again, I'm not in the predictions business, but I think that was a gross underestimation of what the total amount of capital being in the form of stablecoins is likely to be by 2030. And I say this primarily because of corporate treasury. You take one institution like Bank of New York. They have a very strong digital assets team there, and they more recently have made indications that they are making heavier investments in digital assets. That's the world's largest custodian. They've got over $35 trillion. The last I checked, it was $36 or $37 trillion in corporate cash alone.
Yeah.
So just on it, even if they were to give their clients an option to opt in to having a stablecoin form, you would already blow that $4 trillion prediction completely out of the water. And that's just one institution.
Yeah.
Now, why would a treasurer or a CFO choose to keep their assets in the form of a stablecoin? Well, it's just faster to move around. It moves around 24 hours a day. You don't have cutoff windows like you would in traditional money movement architecture. So it seems pretty clear to me that the direction of travel is money moving faster, money moving cheaper, money moving when you need it, where you need it. And all of that suggests to me that a large portion of corporate treasury is likely to move to stablecoin form over the course of the next 3 or 5 years.
Perfect. Yeah. So I think especially on discussing like when we're moving these stable coins, you already mentioned that it's pretty easy, faster to move. Absolutely. But let's say we take one of those payments companies that is working with you or just any company at that point. And they're promising, of course, their customers that cross-border payments will be settled in stable coins because it's faster, it's cheaper than just a bank wire, right? So I can imagine global payments processors talking to merchants, hey, we'll settle you pretty much instantly or the next day at least. As those customers need to pay their suppliers who only accept one particular coin, one currency. Oftentimes that's even fiat. What happens when we need to start expanding that? So do we need to start convincing merchants to accept stable coins, or is that much more of a conversation that needs to happen between the payments processors and the merchants?
It's an interesting question. I don't believe there needs to be a big sale to merchants per se. I think that merchants will be fast to adopt stablecoin frameworks if there is a perceived benefit.
Mm.
Merchants tend to be very kind of aggressive about, saving a penny here, a penny there. You hear a lot of noise from merchants about the credit card interchange fees and the fee stack to utilize credit cards. And so any perceived benefit, I think, will essentially sell itself. Now, if the merchant does not perceive a benefit, that's where you have a challenge and you have a sales problem. But so long as the merchant perceives the benefit, which almost always is either lower costs or you get your money sooner,
Yeah.
then I think that it's a foregone conclusion.
Okay, perfect. Well, for all the talk that we have about a multi-currency future, right? There's still almost entirely a dollar world. Anywhere in the world, the dollar is preferred over other currencies. The market was around $305 billion at the start of the year, and roughly 99% of it was dollar-based. Now we have euro versions, which are barely a sliver of it. So the stablecoin markets.
Mm-hmm.
When you describe a real euro alternative and a multi-currency market, are you describing things where things are today, or are you placing a bet on where they are going?
Well, I think that the dollar is the kind of R&D lab for a lot of the things we've been talking about. We've been talking about programmability, speed, lower cost reductions, and other benefits of deploying blockchain technology in the payment space. And yeah, it's true that the sort of, whether we like it or not, the environment in which a lot of this development is being done is dollar based.
Yeah.
To the degree that there are benefits coming out of that space, to the degree that there are real benefits to some of the things we've been discussing and some of the possibilities, I think that they'll naturally move over to other currencies and other jurisdictions. We currently support at B2C2, we obviously support EURC, but we're in, very close to the founding teams of GBP, BRL, MXNB, Colombian peso, I'm trying to think, Hong Kong dollar, and yen.
Mm.
Stablecoins. That's just off the top of my head. So people come to us and they want to launch their products. Is there a huge amount of demand for a British pound stablecoin right now, for example? No, not necessarily. But to the degree that there's adoption in dollar space, the adoption will be for a reason.
Yeah.
And that reason will likely also apply in the UK, in GBP, and will likely end up being part of the feature set of the GBP stablecoin.
Absolutely. Okay. So I want to bring it back to B2C2 again. You've launched a product. It's called Penny, right? It's free to use. And you've said that the pricing on this trade has to be wafer thin or the advantage over a bank wire disappears. That sounds like a business with no obvious way to make money. Where does the money actually come from, and what stops a better funded rival from undercutting you on margin once that's gone?
We designed Penny specifically understanding that there were likely going to be race conditions, both with regards to how fast it works and with regards to cost. So we designed it to be an instant swap. and you can't get any faster than instant. And that was one moat around the product. And we designed it to really just reflect institutional pricing between stablecoins. And the reason for that, to be very specific, is that there's this assumption in the marketplace that stablecoins should always be worth par, but they're not actually always worth par. And we're not the central bank of stablecoins. There are, I don't need to name names, but there are some really large stablecoins out there that persistently trade below par. And so obviously there would be an arbitrage opportunity if we're willing to buy it at par and people are offering it below par. Yeah, it might only be a cent or even basis points below par, but still in the appropriate amount of size, that's free money. And so what we do is we just reflect what the market believes the correct pricing is on the different stablecoins. And that's a better product, frankly, because a product that tries to distort market prices eventually gets caught out by the market every time. Nevertheless, point being, if someone else wants to stand up and lose gobs of money, we can't stop them. But if it's a rational economic actor, you can't provide the service at a lower cost than simply reflecting market prices, and you can't provide the service faster than instant. Now, why would we do that? It's not exactly going to be the world's largest moneymaker. That part is true. But we believe that we're at the very early stages of a significant technology shift within payment space. And we think there's space for a facility in the marketplace that just becomes the bog standard. It solves a very specific problem that we discussed earlier, the need to accept all relevant stablecoins, but the desire to settle in one or a very small number of preferred Treasury assets.
Yeah.
That's a problem that we hear about from anyone from open banking companies to credit card companies to acquirers to cross-border payments, and the list goes on and on. And we've gotten quite a number of incoming calls from companies all over the world asking if this is something we can do. And we say, great news. We have a product in production, already built. No counterparty risk, instant, and covers 99.99% of the size, transaction size that you'd want. So for all those reasons, we think that Penny has good product market fit. And we're not particularly concerned about another market maker somehow, undercutting us in some way. There are a lot of solutions in the market that are either vaporware, meaning it's a press release, or they are an aspiration. For example, companies that want to offer the marketplace software, but don't want to be party to the transaction and don't have a multi-billion-dollar balance sheet to contribute to ensuring that everything settles and everything works correctly. And we already have those solutions in the market. They're called decentralized exchanges. Pricing is wide and liquidity is not sufficient for a true, top-tier consumer use case. It's perfectly fine for DeFi degens to move around their coins. And so, when you think about needing it to be a centralized function, needing there to be KYC, needing there to be regulation, and needing to have certainty of execution with a balance sheet behind it, we think we have a terrific product.
Fantastic. So there's a number of companies, Wintermute, Cumberland,
My ears. You hear their names.
Well, as you come out of that world yourself. So from the outside, the offers all look alike, right? What can B2C2 actually do that a rival or maybe any new well-funded newcomer cannot easily copy?
We're not as worried about what well-funded newcomers, just to dispatch that. It takes a long, long time to onboard the thousands of institutions that we, and frankly, some of our best competitors, such as a Wintermute or a Cumberland, we have nothing but respect for both of those firms. It takes a really, really long time to onboard a large institutional user base and get your business up and running, earn trust. And so that we're not so worried about necessarily about new startups. With regards to the large established competitors, it's a hand-to-hand combat every single day. We compete on price, we compete on product. We also compete on other areas that are not as obvious, such as operational solidity. We at B2C2 have invested huge amounts of money in our operational capabilities, and that's I think a differentiating factor to some of our competitors who have made more of their investments in front office. So we don't operate at the same scale in terms of headcount as some of our competitors, but we have a super robust back end. We're able to settle our balance sheet multiple times a day. And so that's a feature that a lot of our clients really like, is the ability to settle at any moment in time. It allows them to get their money sooner. It allows them to manage the counterparty risk. And some of these capabilities are not as widespread as you might think.
Got it. Okay. So maybe like when we look at the financial world, there's probably a company that stands really out who you've been able to help, right? You've helped JP Morgan put its dollars actually onto a public blockchain. And a dozen of the Europeans' largest bank are about to launch a shared euro coin with their own wallets. If the banks and the issuers cannot connect to each other directly, what stops them from cutting out the firm in the middle, which probably would be you?
Um, I think that the market structure in payments with blockchain technology is still is yet to be determined, and frankly, I think it's going to be a sort of homogenized market structure. When I talk to payments firms, they both compete with and collaborate with and transact with a wide variety of firms around them. So the refrain we most often hear is that I will say, like, well, hey, isn't that firm your competitor? They'll say, well, in these two countries, or in this one corridor,
Yeah.
or in this one specific workflow, yes. However, we collaborate with that same company in other workflows or in other jurisdictions or other client types, other use cases. And so I think that it's unclear exactly what the future market structure will be. I expect it to be really dynamic, and I believe that our job is to remain relevant to a wide range of different client types, and be really clear about what it is that we're offering them and why we're creating value, how we're creating value. For the time being, the ability to transact 24 hours a day, 7 days a week, settle 24 hours a day, 7 days a week, to have a specific set of products and services around stablecoins. While it's strong to say that that's unique, it's still rare.
Yeah.
It's unclear what will happen tomorrow. It's not likely that we will remain sort of the preeminent service provider in stablecoins forever. But at the same time, the opportunity set is likely to grow as well, in terms of the scale of activity, in terms of the different regions of the world that are adopting blockchain technology and payment space. So while it's true we have an eye out to ensure that we're thinking smart strategically, at the same time, we see a lot of opportunity ahead.
Absolutely. I think it's fascinating to hear because if you sometimes just look at the markets, it goes up, it goes down, it goes up, it goes down. It could be very discouraging. So maybe from your experience, what have you learned about all of those things, like especially with B2C and being in the industry for such a long time? How do you deal, or how should companies deal with that volatility of those type of assets? Or is stablecoin really the next frontier so that you don't have to deal with those type of volatilities?
It's an interesting question. At B2C2, we essentially have three product verticals. Our first product vertical is Bitcoin. Our second product vertical is stablecoins. And then our third product vertical is everything that is not Bitcoin or stablecoins. So we have these product verticals built out, and you're absolutely right that I would say Bitcoin prices have been range bound, and then all other crypto assets have moved around in various ways. In general, though, I would agree that activity levels are low. Engagement currently is reasonably low, and we're off the highs in a lot of assets. And then we saw this whole rash of digital asset treasury companies, many of whom have their stock prices down really significantly since the peak. At the same time, I think that there's a little bit of, I would say, navel gazing within the crypto community about these things. If you look at a whole range of different public equities, you see a lot of household names whose stocks are down 60, 70, 80% from their all-time highs. And you do actually see a lot of volatility there as well. So, that's a little bit of a peculiar answer to your question, but we're not as worried necessarily about where crypto prices are today and where they might go tomorrow. We obviously have no control over any such thing. We have control over what products we roll out and what the client experience is working with B2C2, and that's really what our areas of focus are. We have developed some great products. We mentioned Penny
Yep.
earlier. We have some really terrific lending products that have some really, I think, excellent features, and that's really where our focus is, in serving our clients and ensuring that we're rolling out value-added products rather than sort of just sitting around hoping Bitcoin goes to 200,000, which, by the way, we do hope.
Absolutely. When I see it go to the moon.
Yeah, that's right.
Absolutely. So let's say 5 years from now, if B2C2 has done its job, or you've been successful at executing on your strategy, what part of moving money simply works without anyone thinking about the machinery underneath? And what will it have to do to take it over there?
My expectation is that moving money will become increasingly easy. The reduced friction. My expectation is that there will be, right now, there's essentially a very small number of networks that allow you to move money, but either domestically or internationally. And I suspect that these networks will start to compete with each other. I mean, a great example is Stripe. I have no knowledge of what's going on inside Stripe, obviously, but it's a company that not only I, but I think almost everybody in financial services has a lot of respect for. We could easily see a situation where a increasing amount of merchant-to-merchant financial activity is done within a Stripe network and never to really touches a bank.
Yeah.
As that's the kind of thing we could see. We could also see Stripe, if there were a regulatory snag, Stripe would simply just purchase or somehow collaborate with a bank to satisfy the regulatory need. As you know, there's a lot of these types of services already in the market: banking as a service, regulation as a service, things like this. And so what you end up with is a market structure where you have a variety of different networks to accomplish your task, and these networks compete with each other. From a market structure perspective, that's not radically different from what we see currently in digital assets or crypto, where you have a number of L1s competing for transactional activity. You have a range of L2s, scaling solutions to make their respective L1s faster, again, competing for activity as well. And so you could see a future world where the market structure is multiple networks, and the user experience is really one where you're able to choose whatever network is faster and cheaper. Earlier in our conversation, you mentioned agentic finance and agentic transactions, and I don't, while I believe that that's the future, it's also a bit of science fiction at the moment, so I want to stay away from it a little bit. But the only point I will make is, rather than the user experience being that you need to do a heavy amount of research and investigation to figure out for any one transaction what might be the fastest or cheapest, it's very likely that that type of workflow will be devoted to a machine in the future. That's a pretty easy prediction to make. And so the user experience is very likely, this is my wallet or account, however you want to refer to it. This is some place where I keep my money, and I want to take this amount of money and send it to some other place where they keep their money. There will likely be a passive background KYC, KYB, AML, OFAC, screening to make sure that this transaction is kosher and that both nodes are kosher, and then it'll run through the cheapest path.
Yeah. I'm a very future-focused, optimistic guy. And I like to ask each one of my guests, like, there's always roadblocks ahead, right? Regulations that are popping up in the US and Europe, challenges on technical basis. We haven't even dove into AI or anything like that. But what is something that you're seeing as maybe a roadblock or a challenge right now that needs to be resolved, especially if we want to see more adoption of stable coins and, of course, B2C2 as a company?
I think we still have work to do, for one, on security, right? So one of the things that thankfully we haven't spent a lot of time talking about is DeFi. And the reason I say thankfully is because, as much as I think the promise of DeFi is really exciting, these constant hacks are just, it's abundantly evident that this is a product that has a lot of product development to do. I mean, it's not just one product, obviously. It's an entire marketplace, and it's thousands of well-meaning professionals trying their best to build, and builders, and you have to respect that. At the same time, the state of affairs with regards to security is just not acceptable. So that's one critical area. I think a lot of the regulatory questions are being cleared up as we speak. So we've got, obviously, legislation coming through Congress in the United States. We've got some activity out of Europe as well. And Singapore has been kind of forward in its regulatory posture as well. So I think that area is getting cleared up. I also think that the in the United States, the crypto digital asset community has arguably overindulged in getting itself really, really close to some politically toxic entities.
Mm-hmm.
And it's quite possible, if there were a change of control in some parts of the government, that could end up being a problem for us down the line. We went from being blamed by the Biden administration for a lot of ills that were not of our making, and I think there was a very strong anti-crypto bias in the Biden administration for reasons that remain unclear to this very moment. But I think that the industry in general over-indexed on political contributions to one side versus the other, and that's not likely to work out well in the long run.
Perfect. Well, thank you for that answer. And thank you for joining us here at Executive Conversation. And it was great to speaking with you.
My pleasure.
Thank you. If you like this episode, hit like, follow, and subscribe for more.